Good morning and welcome back to Medicine to Macro. Today, we are going to talk about some of the big memory chip providers and how the market reacted to some of their projections and the money that they are earmarking for building out more of this AI, and the market questioning whether or not they are going to be able to continue with this extreme memory chip demand. Also, we're going to look at inflation expectations and why I believe the market is offsides on this and what the ripple effects may be for assets downstream. And then I'm going to highlight the biggest risk in the market right now that you may not be paying attention to, and then also what I'm doing with my own portfolio. So let's get into it. Bring up the screen share here. All right, so first we're going to talk about Samsung. Posted 1,800% jump in profits, but of course it all comes back to these spending concerns. So it closed nearly 7% lower on Tuesday today, with a second quarter operating profit of almost 58 billion versus, it gives me the other, or rather the recent 57 trillion won in the prior period. So this is an enormous jump, but it's been dragged down by concerns that AI infrastructure spending can't keep growing at the pace that's been driving memory prices. So you've seen this enormous amount of capital expenditure, almost $1 trillion that's been earmarked for next year, right? And the market is saying, well, you know what? I don't know if that's going to be able to continue. That's probably the only reason that the memory, it's this bottleneck that's caused this massive increase in prices, okay? And I wanted to highlight one other thing. Samsung also pledged to build a massive semiconductor fabrication plant in the southern part of the country. So the market, when they released the results, they sold off on this news because, again, it comes back to how much money are these companies going to continue earmarking for this massive build out. And there was actually there wasn't a massive sell-off, but SK Hynix, Micron, they all saw weakness today as well. So it just goes to show that this is kind of the market's reaction. They're buying the rumor and selling the news on these large companies. And SpaceX, of course, why not more? Why not add SpaceX onto the NASDAQ 100? All right, so Goldman Sachs and some of these other very large firms, they've become very, very bullish on SpaceX. They're pumping it, their projections on their price. I think I saw some that said that SpaceX should be around $300. For all of you real estate investors out there that are watching this, it is very important to remember that SpaceX, now that it's been fast-tracked onto the NASDAQ, there's going to be buying. It's not complimentary, it's forced buying by these leveraged ETFs. Almost 52% of all capital flows are due to passive index funds and ETFs now versus almost 11% back in the 2000s. Okay, so it's completely devoid of fundamentals. SpaceX was released at about 100 times sales. So we're really starting to see that capital is being strong-armed into buying this stock. You do what you want. Again, this is not investing advice. I'm just highlighting the risks that come with this. And you can see, and this is on Yahoo Finance, right? So very mainstream, major brokerages, Morgan Stanley, Goldman Sachs, bullish ratings, highlighting companies' strong long-term growth prospects. And it's at 100 times sales, right? And it actually lost revenue over the last quarter. A lot of people don't know that. But again, this is the narrative it's fueling the fire, right? And it's galvanizing people to throw a lot of their hard-earned money, whether that's through 401ks or through active retail, into this asset class, okay, or into this stock. And then down here, Morgan Stanley initiated coverage with an overweight rating. And here's the $300 target, implying an 87% upside from the last closing price. I'm very, very skeptical of that. And here, the SpaceX officially joins the NASDAQ 100 on the fast entry rule introduced in May. That is such coincidental timing. So the fast entry rule in May allows SpaceX to be put onto the NASDAQ, opening up a lot more capital. Because again, for the AI build out and the AI narrative, this SpaceX IPO had to go extremely well. All right. So that is that. So I just wanted to highlight that. The next thing I want to talk about is inflation expectations. So over the weekend, maybe not the weekend, but I think it was last week, this gentleman, Kevin Warsh, he's got a big smile on his face. Inflation risks have declined in recent weeks. Now, why is this important? This is important because on the backdrop of the decrease in oil prices, almost to pre-war levels, the memorandum of understanding that occurred, now the rhetoric coming out of not only the Federal Reserve, but also the European Central Bank and a lot of other central banks have dropped their inflation forecasts quite precipitously. So down here, I'm just going to scroll down and highlight Lagarde. Christine Lagarde is the president of the European Central Bank. She said she agreed with view on inflation, saying the upside risks to inflation and downside risks to the economic growth are probably more broadly balanced. So they're switching their tone, right? So over the last couple of months, we've had the closure of the Strait of Hormuz. Oil has spiked. That is a supply shock inflationary pressures, and they didn't know how it was going to turn out. And so now with the reopening of the Strait of Hormuz and their circumvented oil that's going through Saudi Arabia, through Oman, oil is back to pre-war levels. Now they're saying, hey, you know what? We actually are, we think inflation is going to come down, which will lead to possible rate drops in the future. This is all about expectations, guys. Okay. So the market, and this is crude oil here. You can see from March, it went all the way up to 111 and then back down to now we're about 70. Okay. So the market, it has expected that the dollar, or that the market has expected that rate hikes are going to come because of the inflationary backdrop from increased energy prices. Now that that stimulus is gone, and now that Kevin Warsh and other members of different central banks around the world, they are liberalizing or changing the rhetoric around inflation. And this is important because as inflationary pressures come down, that means that the expectations around rate hikes, that will decrease the strength in the dollar. Okay. And this is why I wanted to highlight this. So our 10-year yield, this is extremely important. It got up to about 4.46. It's been coming down to this channel here, and it's lying around 4.472. The line in the sand for the 10-year yield is 4.5%. So throughout the war, as the 10-year yield has gotten to 4.5, remember, there's an enormous amount of U.S. government debt floating around, and about $10 trillion of that needs to be refied this year. Okay. Also, as this 10-year yield gets higher, that bleeds over into the borrowing costs of everyday Americans, whether that's your mortgage, whether that's your credit card debt, your auto loans, etc. All right. As this yield goes up, that pulls people into the dollar because on a relative basis, you're getting compensated more based on that yield for being in the dollar. All right. And something we need to watch coming up tomorrow, we have a 10-year note auction, $39 billion. And this doesn't get any fanfare. Nobody talks about it, but it's extremely important, right? Because our largest creditor, Japan, has been having to defend their currency. The yen, where we're going to talk about this in a little bit, it's at almost 161. It's been extremely weak. And then last week, they supported the yen, or rather bought yen back by liquidating some of their dollars. This is extremely important because as these auctions come up, if our largest buyer of US debt is now a liquidator of debt because they have to support their currency, that means that these most likely are going to close at higher yields. And that's going to cause a spike in the 10-year yield, thereby strengthening the dollar, all right, which is going to hurt a lot of assets that trade inverse to that. And we're going to go into that. So now here is the DXY. As you can see, since, let me get this out of here, September of last year, it's really been trading between a band of 96 to 100. And for those of you who don't know, the DXY is just a relative strength or weakness of the dollar versus a basket of Western aligned currencies. Mostly the yen, about 14%, and the euro, which is about 40%. Okay. As the dollar goes up, this causes a lot of pain in the global financial system because there is an unprecedented amount of short-term dollar-denominated debt. floating throughout the system. As the dollar strengthens, that means that that debt gets more expensive and they need to pay it back. So it's much more short term. And so the pressure is on these other countries. All right. And different entities as well. All right. So what I'm looking for here, and I'm going to kind of scroll in here. I've got the 8-day or the 20-day and the 50-day moving averages. These are just averages that I look at, a little bit of technical analysis. As you can see here, it broke above that upper resistance. Now it's coming back down to the top of that line. I want to see the dollar start to go through the 50 or the 20-day and the 50-day along with negative momentum. And that will make me much more comfortable in terms of reallocating back into assets that do well in a weak dollar environment, whether that be gold, whether that be silver, just consumer discretionary. Why do I say consumer discretionary? I say that because as inflationary pressures come down, as energy and food prices come down for the consumer, then at the margins, they have more money to spend out in the economy. Okay, so think your Walmarts. Think of these companies that as people are able to spend more, their bottom line is going to be affected in a positive way. Okay, so we talked about the yen briefly. So here, why this is important is as the yen has gotten to 160, Japan is an importer of 90% of its energy and about 70% of its food. As the yen gets weaker versus the dollar, all of their energy and food imported is in dollars. So they need to spend more yen. They need to buy more dollars, which takes more yen, causing further weakening of their currency, which bleeds over into higher inflation for the average Joe and Jane. Very good for the exporting countries in Japan. And like I said, they're a major holder or a US debt. But this is really a line in the sand. You see, this is what's called, this was a intervention whereby they sold some of their treasuries, they bought their yen out of the market, but it really didn't hold. And you've seen another intervention, and right now it's at almost 162. Okay, why this is important is you've got these enormous Japanese insurance funds and pension funds that over the last 30 years have borrowed yen cheaply because of the yield curve control in Japan. And then they've recycled that into dollars and bought dollar denominated corporate debt, government debt, bonds, stocks, you name it, right? Because the relative yield on a 10-year US Treasury versus the Japanese yield is still higher. But here, as you can see, this blue line basically means that delta, the difference between holding a US Treasury and a Japanese government bond, is starting to shrink. As the relative attractiveness of this yield goes down because it's catching up, because the normalization of the yield curve in Japan is occurring, they're allowing their yield curve to normalize because over the last 30 years, like I said, they've been practicing yield curve control to keep their currency down, to keep their interest costs down. So as that occurs, you will likely see repatriation of capital back to Japan. Now, it hasn't happened yet. I don't see any signals that that is about to occur. But like I said, the more interventions that they're doing, it's having less and less and less of effect. The only way to counteract that is to raise interest rates. As they raise interest rates to the point where that relative attractiveness starts to compress, then that capital is going to come back home, which is going to lead to much lower asset prices in the United States. So I want you to be prepared for that. I will let you know as I see signals that that will occur. One thing to keep an eye on is we have CPI next week. That'll be important to manage inflation expectations. And then I think it's at the end of July, we have the Bank of Japan has their next policy meeting, and I'll keep an eye on that and I'll let you know what I see. So lastly, I just wanted to let you know and paint a picture of what I'm doing with my own portfolio. Right now, I'm playing defense. I work full time. I don't have time to watch charts all day. So I wanted to, and again, this isn't investing advice. I'm just explaining what I'm doing with my own portfolio. And it's a mutual fund called STU. And I love STU, but I also love this mutual fund. And I'll tell you why, because it's got a distribution rate. It's almost on par with a 10-year yield interest rate. The market price is at 18. The NAV is at 23. So it's actually trading at about a 25% discount. But I want to highlight what companies are in here. Berkshire, JP Morgan, basically the Fed. Enterprise Product Partners. For those of you who don't know, that's one of the largest midstream natural gas companies. And with AI and the European Union and Europe needing our natural gas, I think these are extremely strong companies, right? So this is just something to consider. All right. So with that, guys, thank you very much for your viewership. Thank you for listening. If you have any questions, make sure to drop them in the comments and I'll respond. Remember, movement is medicine. The more you move, the more that's going to ripple over into making sound investing decisions. As always, stay safe, and I'll see you on the next video. Cheers.